Builders. I usually like to get my data sources twice. I've only gotten this one once, but given we were going to talk about it, I added it. Builders, historically speaking, going back to the 90s, first-time home buyer, affordable homes, whatever you call it, used to be 40% of the building product. This was pre-Great Recession, so maybe that had something to do with it. I don't know. But today, affordable new builds are 7% of the market. It's not where the profit is. The overhead to build, the lot fees, whatever they have to be charged, they have to build bigger homes. They can't build them affordable. And then the last one is, I believe we've had a lot of demand pulled forward. I believe real estate home buying is a payment-based. 2020 was the best year in the last 50 years to buy a home, price and rate. I think a lot of people that could bought early. A lot of people that bought a second home bought early. And now we just have this huge gap of demands like, hey, I already got mine. I don't need another one. Yeah. So these are all things why I think the Fed broke housing. The housing market is broken. Any thoughts on all of this? Because I've been rambling because it's so broken.
Yeah, well, just so on the last point, I mean, you and I have talked about this quite a bit, about this demand pulled forward because of COVID. All those people who, especially in big cities, who had been putting off the decision to move to the suburbs, you know, a lot of them were spurred to action by COVID. And so that's one thing, but that's like a temporary, like frog moving through the snake kind of thing.
Right.
But yeah, as far as the other things are concerned, I mean, I think a lot of it has, there are probably two things. One is the Fed, right? And I think it's right to point fingers at the Fed for keeping interest rates too low, too long. Right. And that has certainly, you know, we've talked about this a lot on the show too. It's created the dynamic where, you know, because the payments stayed low, the prices could rise, and then you wound up in a situation where only the people who could, you know, have the down payment together could buy a house, right?
Yeah.
And so that's a big problem. So I agree. The Fed has been normalized. Interest rates should have happened much sooner. And you know, even though, you know, you and I are real estate investors, and real estate investors kind of, you know, salivate over low interest rates, it's really kind of a temporary thing. You know,
right.
Low interest rates are great when, you know, when the housing cycle is at its bottom and you can get cheap financing and buy cheap assets at the same time, and it's like great. But if the Fed keeps interest rates too low for too long, you wind up where we are now, where every asset is inflated, and everyone's worried about rising interest rates destroying the value of what they bought that was inflated when they bought it, right? But what are you going to do if you're in the business? You got to keep on buying, right? So you don't really have a choice. And so then people are, you know, there are a lot of people saying the Fed shouldn't raise rates because it's going to hurt them, right? But on a kind of a long-term macro view, we have to get back to regular normalized interest rates, which is going to be painful. And, you know, it's just like you drink too much, you're having a great time. It's all fun until, you know, you start puking your guts up, and then it's really unpleasant.